If you've ever felt like you take one step forward and two steps back in the stock market, then this video is for you. In this video, I'm going to show you how to do the exact opposite and maybe even get you to a point where you're taking 3 steps forward and only 1 step back. In life, there are many rules and principles and natural laws all around us. And in today's video, we're going to be talking about a game-changing principle that's been around for 125 years that is so applicable to the stock market and honestly many other aspects in life. And I guarantee that if you truly apply this principle to your trading, you will see the stock market in a different way. So as traders, a lot of times people are so concerned about, when they're looking at any given strategy, about, win rates or win percentages. And while that is important, if you only care about the win percentage of a strategy, you will lose money quicker than you could possibly imagine. Because at the end of the day, you could have a 90% win rate, but if when you win is small compared to when you lose, you're just going to blow your account. So it's like, not only do you have to care about how much you win, but it's like when you win, how much are you actually winning? And when you lose, how much are you losing? Because at the same time, you could have a 30% win rate, but if you lose, or when you lose, if there's small losses compared to when you win, you can grow your account significantly over the long term. So that's very important, and this is exactly where the Pareto principle, aka the 80-20 rule, comes into play. I'm sure all of you have heard statements like 80% of the land is owned by 20% of the population, or 20% of the businesses out there make 80% of the profit, or 80% of traffic is on 20% of roads, or even like 80% of news coverage is based off of 20% of the world events, or like 20% of the apps on your phone are used 80% of the time. The main thing is that the majority of, I guess you could say, effects come from only 20% of the causes, you can say. And basically, that is the 80-20 principle. And the thing is, it's not always 80-20. Sometimes it might be 90-10 or 70-30 or anything like that. So how does this connect to trading, right? Obviously, those examples that I talked about with the land and the news coverage and the apps are all self-explanatory. But when it comes to the stock market, it's a little bit different, right? It's very, very important to notice and observe the stock market in a, Pareto way, you can say, or an 80-20 way, where basically, 80% of the opportunity only shows up 20% of the time. And that can be looked at in many different ways. Whether you're a long-term investor looking for major market dips, or whether you're a day trader trying to day trade Tesla stock, or, whatever your strategy may be, the top 80% of the opportunity will show up only 20% of the time. And like I said, it might be 90-10, it might be 70-30. Obviously that depends, but you should get the point. But the thing is, like, let's say you're looking at Tesla for like short-term trading. Most days Tesla will just, move up or down, an average amount. But some days it'll pop up by like 20% or 15%, and that's where most of the opportunity is. Or even if you're looking to day trade SPY or, something else, right? Like most days it'll just be normal average movement, but in 20% of the time or 10% of the time is where like so much of the opportunity will be. And if you miss that, it can just be absolutely disastrous, right? And that's why it's key to understanding this principle and actually applying it to your day-to-day trading. And even if you're a long-term investor, and let's say you look at a long-term chart of the stock market, the biggest dips happen, in the rarest times, right? It's like you don't see most of the opportunity comes from like the very scarce events, like the COVID crash, or like the big sell-off at the end of 2018, or even like the Great Recession. So that's definitely worth noting. And what's also very key to notice is, like, let's say we go to, a chart of Tesla or any other stock, whether it's Tesla, Apple, literally anything else out there, you will see that every now and then there's just a giant move, and it's absolutely critical that you don't miss those moves. So check this out. Here's a study done by Putnam Investments, and basically what we're seeing right here is data from December 31st of 2007 to December 31st of 2022, right? If you would have just bought the S&P 500 and held the entire time, you would have turned $10,000 into $35,000 $461, right? But out of all of those days, out of that 15-year period, if you would have just missed the 10 best days, instead of turning $10,000 into over $35,000, you would have only turned $10,000 into $16.2 thousand just by missing the 10 best days over a 15-year period. And it gets a lot worse. So basically, that's only if you missed the 10 best days. If you would have missed the 20 best days, you would have actually lost money. You would have turned $10,000 into like $9,700. You would have lost money just by missing the 20 best days over a 15-year period. This is why it's so crucial to truly and deeply understand the 80-20 principle and the, Pareto principle. You can say that. Because most of the opportunity, most of the best movement, the best days happen in only, 20% of the time, or just a minority of the time, right? And if you go about trading without understanding where most of the opportunity truly lies, it'll be a lot harder to grow your account. In the same way that not all stocks are created equally. Like I say this all the time. Let's say we look at the S&P 500. Companies like Apple and Microsoft and Amazon have much more of a direct influence on the S&P 500 than a company like Johnson & Johnson, McDonald's, and Chevron, right? All 6 of those companies are powerhouse multi-billion-dollar companies, but at the end of the day, those tech stocks like Apple, Microsoft, and Amazon just have much more of an influence on the market. So not all stocks are created equally, but in the same way, not all days are created equally. If we look at the S&P 500, a lot of times you're just going to see, average and normal movement where the market just lollygagging around, right? It's just, moving up a little bit or moving down a little bit. But in those, 20% of days, or, those 10% of days available is where almost, I don't want to say all, but most of the opportunity will lie, right? Whether it be some major event with interest rates, whether it be earnings for a specific stock, or whether it be any other crazy event or news article that can draw most of the opportunity, right? And you have to be aware of that. So in terms of applying this to your trading, you have to show up every day because, like I said, just from this study right here, over a 15-year period, if you would have just missed the 10 best days, you would have made nowhere near the amount of money, right? That's why you had to, stay invested the whole time. And if you missed the 20 best days, you would have actually lost money, right? So whether you're long-term investing or whether you are day trading or doing some other form of short-term trading, you have to show up every day and you have to understand that most of the opportunity happens in a minority of the time. So keep that in mind. When there are game-changing events and news in the market right now, you have to strike when the iron's hot, and in the same way, when you have to strike when the iron's hot because of some news or big event in the market, you should not necessarily be going, too crazy if nothing is happening in the market. So for example, if we know that 80% of the opportunity happens 20% of the time, if there's nothing going on in the stock market right now and nothing's truly moving and there's not really a great setup, you don't have to trade that. And also too, if you did want to trade it, feel free to scale down the size a little bit until you actually have, that 20% of the time opportunity, because, that's where the biggest, I guess you could say, opportunities are at. So overall, the Pareto principle is so important to the stock market and also life in general. It applies to so many things. And I think if you truly understand it, you can save yourself a lot of wasted unnecessary losses in the stock market. You could also have bigger wins over the course of your trading career. So if you like the video, make sure to subscribe. I'm going to make a lot more videos like this. And when you subscribe, you'll see my videos recommended to you more often. And if you like this video, definitely make sure to check out the video on the screen right here. If you trade options, it is the video to watch in terms of exit strategies. Thanks for watching.